The mortgage stress tests introduced last year have improved the quality of new mortgage lending. As a result, the share of new mortgages going to highly indebted households, those that owe more than 450% of their income, has declined significantly. Also, the number of Canadians falling behind on their debt payments remains low. The combination of the revised mortgage guidelines and past increases in interest rates have helped to slow the pace of household borrowing and stabilize the overall household debt-to-income ratio in Canada. These are encouraging signs, but there are important reasons for continued vigilance. First, because the total amount of debt carried by Canadian households is so large, we know that it will be with us for a long time. Second, a large share of this debt is with highly indebted households. And third, the decline in global bond yields since the beginning of the year has lowered Canadian mortgage rates, so household borrowing is likely to pick up again. The bank is also closely monitoring the risk that stricter mortgage guidelines are shifting consumers away from federally regulated institutions and toward private lenders and credit unions, some of which are not following the federal guidelines. The overall risk to the Canadian financial system has increased slightly since our last assessment nearly a year ago, but this is due to the recent slowdown in economic growth in Canada and abroad. However, as we said on our recent monetary policy report, we do expect economic growth to pick up later this year. As for the risk of a severe house price correction, we judge that to be moderate and declining, with froth having decreased in the Toronto and Vancouver areas. Meanwhile, the risk of a sharp increase in long-term interest rates, driven by higher global risk premiums, is moderate but is increasing.